Live. My name is Marina Mets, and I'm the head of Americas for fixed income and multi-asset index product here at FTSE Russell. It's my pleasure to be hosting today's session. In today's episode, we will be exploring how asset managers can navigate the volatility we're all living through in fixed income markets. From an indexing perspective, we will be exploring how asset managers and can best view the space. So, having managed the indices, one of the cornerstones is, of course, effective valuations of the underlying assets. Indices are barometers of the fixed income markets, and as such, we're large consumers of diverse data, which is synchronized through the indexing lens to facilitate decision making and direct the flow of capital. In this regard, transparency of valuations used are very important to both the index and, of course, the asset management community that we serve. Within LSEG, we work very closely with our colleagues in the Refinitiv evaluated pricing team to understand the dynamics that underpin valuations and the tools that these experts are applying to ensure valuations remain representatives in today's fast-paced and volatile markets. So today is a fantastic opportunity to share these insights, and hopefully we will have time for some audience questions towards the end of the live stream. If you have any questions throughout, please pop them into the comments and we'll do our very best to answer them. I'm delighted today to be joined by my colleagues, Steve Dix, who is manager of EMEA Fixed Income and Derivative Valuation, Steve Martin, who leads our sovereign and corporate bond valuations in the US, and Don Ojo, Senior Valuation Lead for Securitized Products. Welcome, gentlemen.
Good morning.
Hi. Good morning.
Hello.
Good afternoon.
Morning, everyone. Morning. So let's dive right in, starting at the top, I guess. So this year has certainly been an interesting one for fixed income. We're seeing inflation, geopolitical risk divergence, very aggressive rate hikes in a coordinated effort by G7 central banks, yield curve inversions. As a result, of course, markets have seen unprecedented volatility, especially in the rates market. Steve, in your experience evaluating through sovereign rate securities, what are you seeing in the market? How are you seeing clients react? And what are we doing to help them cope with that volatility?
Thanks, Marina. Good morning. To the European theatre to begin with, what we're seeing this year has been a multitude of contributing factors, starting with a transitory inflation segue into more sustained inflation, a huge dysfunctional shift by the Ukraine-Russia war and all it's meant for commodity prices, and a reaction function from central banks that I argue has maybe been a little bit later, more pronounced. As such, we're seeing more and more volatility on the price basis in the European sovereigns as bond markets rethink the concept of what the risk-free rate is, going from below zero in Europe's case and to virtually zero to something much higher now, and what it has as a knock-on effect for valuations. What that gives us in the European team is a much greater day-to-day volatility. Yields are 15 to 20 basis points in the sovereign curves up and down are now the new normal for us. My background is in fixed income trading from the early 90s, and I've seen some moves like this. It is fascinating and nonetheless challenging at the same time. And we do see a lot of client interaction coming in and asking us about price moves and levels on long duration securities. For example, in Austria a couple of years ago, maybe 3 years ago, they issued a 100-year bond with a 1.85 coupon on it, and the moves down in price and that have been quite substantial some days, as we've seen a repricing of central bank expectations, and clients do consistently come into us and check that the levels we are publishing are what they are consistent with what we're seeing, and of course they are accurate. They're just surprising to clients. Every now and again markets have a real break, and we saw that in September in the UK, especially when the was announced that this mini budget from the current government. This was an unfunded event, which was dramatic, and essentially the bond market said no. It became very challenging to use. The volatility, we were seeing 100 basis points moves in sovereign bonds, especially in the inflation-linked bonds intraday. It was challenging. It was interesting. It was volatile. But nonetheless, we had a lot of clients come back and check us on that. But we were seeing enough visibility in the market to validate our prices, and we were okay with the levels. It was just that, we have not seen these kind of price moves in probably 30 years. And so therefore we had to sort of call on expertise to make sure that we could support our pricing and the levels were consistent with what we were seeing in partial visibility. I would not say complete visibility, but partial. So I would say it's been an interesting time. It's been a challenging time. Clients have been a lot more frequent on the big markets, but we've been fine. We've always have to take color. We always have questions, and we always have to answer those questions to support their valuations. Marina,
Absolutely. Yeah, thank you, Steve. Absolutely. I mean, I think in my experience, being able to provide that color, being able to query those prices becomes an incredibly important thing. So I'm sure the clients are reacting well to having some comfort in the fact that they can contact your team of experts to get that. Steve, looking at this a little bit from the angle of the corporate space, obviously we're seeing whipsawing in rates. As people grapple with what does the curve inversions mean, whether they're a signal of recessions, what does that mean for corporates and the corporate health? Are you seeing the same kind of volatility permeate into the corporate credit space? And are you seeing similar market color there as well?
Yes, hi Marina. Yes, we're definitely seeing the same volatility in the U.S. Since the beginning of the year, U.S. corporates, emerging markets, sovereigns, we've certainly been in a downward trend. With interest rates rising, it has a big effect on our securities. U.S. Treasuries are used as the benchmark for investment grade corporate bonds, and are approximately 240 to 280 basis points higher in yield since the beginning of the year. The spreads to treasuries are also widening, which is putting added pressure on the bonds. So let me just give you a couple of examples. A very liquid Apple 30-year bond, rated AA plus. The price dropped over 37 points since the beginning of the year. And the 30-year treasury is 242 basis points higher in yield. The spread is 21 basis points higher in yield since that time. If you look at a Boeing issue, it's rated BBB minus, so a lower rated issue. Price is down over 54 points with a spread widening of 80 basis points. So what you'll see is the lower the credit quality, the larger the widening of spreads. In high yield, we're coming out of an environment that historically we have, low yields, probably around 4.5–5%. Currently a typical double B credit is around 8.5 to 10.5% right now. Most U.S. high yield issues a dollar price. However, if you look at the yields and its relationship to treasuries, it's around 175 to 300 basis points wider. And then also we do handle emerging market and sovereign debt in U.S. currencies, and it's a similar story. There are a lot of below investment grade issuers in the space, and we've seen yields bounce around dramatically on a daily basis. The B-rated sovereign issues like Egypt, Nigeria, Turkey, Pakistan could fluctuate 25 to 100 basis points on any given day. And currently we're seeing yields in Egypt 12.5 to 14%, Nigeria 11.5 to 12.5%, Turkey 8.75, 9.75%, and Pakistan 25 to 65%. So it's a really, really large yield. And Pakistan is trading at distressed levels, and most of their issues are in the $30 price. So high inflation is definitely putting a lot of pressure on all of our markets.
Yeah, I mean, what's been interesting to observe is, as given the kind of artificially low rate environment that we've come out of over, the last decade, if you will, a lot of investors have moved into these parts of the curve and parts of the market, right? Chasing for yield. So, we've seen a ton of interest going into high yield, going into emerging market debt, and given the kind of rate volatility we're observing in, DM markets across the world, obviously the stuff that we've saw come out of the UK, it's been interesting to watch kind of the shifting of the capital between the various stacks. Are you seeing any kind of client feedback around their ability to price in the high yield space, their ability to continue to access these kind of markets, and frankly, from I guess your perspective, this market color that we talked about and the importance of this market color, are you guys observing that you're getting enough of that in order to be able to satisfy client questions and still remain in terms of trading?
We're certainly seeing a large amount of market color coming in. We get live trades from FINRA, which is Trace. If people are familiar with Trace, that is a feed that comes directly into our pricing models, and then we get live two-sided dealer quotes coming in as well into our model. So it's very important, and then also. Staffing is pretty important, so, experienced staff monitoring the movement on a daily basis and understanding what that movement means is really, really important.
Yeah, I couldn't agree with you more. Our team on the indexing side has a ton of conversations with clients together with you guys. And I think I've certainly seen clients really appreciate, because it's one thing to look at a model and it's another thing to be able to understand what it's kind of telling you. And in that situation, the experience, I think, becomes invaluable. Absolutely agree. I think, thinking of models and speaking of kind of the rate sensitivity, Don, I have to ask you about mortgages, right? One of the larger parts of the US investable universe, sits about a third of the overall kind of investment grade portfolios. A huge sensitivity to rates within the underlying mortgage space. What are you seeing, given the complexity of these kind of instruments, the sheer volume of the number of mortgages that have to get priced, and how's your team responding to those evaluation demands?
Yeah, so this year has been actually quite interesting for us. We've since the Fed started raising rates, the real issue has been directionality with the market, which you have seen as the Fed has raised rates about 300 basis points. You've seen mortgage rates respond effectively, moving higher significantly. So before last week, we were over 7% on the standard mortgage rate. Now, the impact of that on securities is obviously a slower prepayment and extension and duration. This is obviously caused in the mortgage space call protection to significantly decline. So what you've seen across the board, whether in benchmark TBAs or in specified pools, is significant price declines across the board. In mortgage derivatives, say like in IOs and supports, specifically supports, you've seen significant extension on what was originally short-term paper, effectively 3% on a one-year duration, extend to about 13 years, and pricing at significant declines, significant discounts. So it's been a challenging period if you exclude last week when the CPI data came out, and basically the market started moving a little bit differently as the rates kind of came in a little bit.
Yeah. I mean, the rates are obviously whipsawing around. We've obviously seen the Fed continue to push the same rhetoric, trying to stabilize at least expectations. I think by all accounts, we're all expecting more volatility to come. Obviously, a hugely important part of valuations, and we've all talked a little bit about this both in terms of primary rate markets, credit spreads, but specifically in mortgages, is the underlying models that support this very complex, very kind of technical asset category. Don, maybe starting with you, but then also Steve for yourselves as well. How are you seeing the models be able to recalibrate to this kind of volatility? Because we keep on seeing more and more, third deviation events coming through the market. So, how have you been able to calibrate the models? How are clients responding to that? And, what does that technically mean in terms of the valuations that are coming through? Don, I think
Don, you're on mute, bud.
10 cents in the jar.
I think he's back.
Okay, do you have me? Apologies for that. So
that's how well the model recalibrated.
Exactly, right?
He's back.
So I'll just a little bit on rates. The question is what we're going to see moving forward. We did see pretty good CPI data coming in last week. So I was reading an article about the Taylor principle. What future expected rates are going to be, and how much the Fed has to go up. The early indication, if you're looking at forward expectations, is about 150 basis points left. This is crushing models even more. So you can think about some, basic points inside of particular models, such as HPA, primary secondary spread, and refinancing S curves. You can imagine that this past year, if you look past COVID, what you did see was massive increases in HPA. But as rates rose, you saw big declines, and models have found it a little bit difficult to adjust. So what we've seen is actuals in the fixed space in the 30-year, it's about 5 CPR, and models are slightly faster probably in the 10, 12 CPR area. So what that means for us is that our bonds, since we will apply models in some cases, our bonds are effectively shorter, and we have to make a spread adjustment because the actual bond is longer. So it's been a challenge. I know model providers are trying to make adjustments. I know our partners at Yieldbook and other providers are also trying to make adjustments in this area. But the difficulty for them has been in the steepness of S curves that reversed itself, and the changes in the primary secondary spread, which is outside of the range that they had imagined. I mean, so we were looking at spreads in the 180 basis points area, which is outside most models.
Yeah. Steve, on the rate side, are you guys seeing kind of a similar adjustment that has to get made, right? I mean, we're coming out of negative European rates. We're coming out of, very flat kind of curves to all of a sudden this like huge, very fast-paced rate hike across the world, across the major currencies. Are you seeing, besides being able to adjust for the vol, are you seeing having to adjust any kind of modeling that also takes place inside the actual rate, given that it underpins the remaining of the pricing, frankly, right?
Yeah, I think it's a good question. Thanks. I would say that it has been, but we do get regular. I mean, the IPO market is much slower this year than it was last year. So obviously because of higher rates and people don't want to necessarily refinance. But certainly, if I look at the corporate space in IPO and say the sovereign space in Europe, there's been enough of new issuance to give us a sense of where investors want to own that risk at that point in time. And we can then use that to look at our secondary market that we're currently pricing to ascertain whether our levels remain valid, or whether we should apply more of a premium price discount, if you like, to capture the change in sentiment. So it's been probably, as we get volatility, these IPOs and these issues, it can be a little bit more gappy. And sometimes you've got to cross-check it. It has moved a lot. But we have been calibrate our rate, okay? I would also emphasize, just highlight, don't forget that in June, July, the ECB, European Central Bank, announced that they were going to start hiking rates. The market did have a little bit of a heart attack then, and Italian bond spreads widened up quite dramatically. And the ECB then in and sort of announced not a QE, but a QE to stabilize those spreads. So in some ways, we've had that backstop. I mean, I don't like market handler backstop. I should be free to trade, but there is that kind of implicit backstop. I thought the Italian market, which is a large sovereign market, it implicitly at least keeps the other sovereigns sort of in play. However, the core are a little bit more fragile, but nonetheless, as I said, there's enough issuance for us to get a sense of where those credits are trading.
Yeah. I mean, if I kind of remember from the days of these, a lot of the pricing is done, as we talked a little bit, with kind of spread dynamic in mind, right? So you price the rates, and then you look at your credits as a kind of matrix adjustment against those credits. So obviously increased rate volatility, even without the spread kind of widening that Steve talked about, and the spread vol will mean, obviously vol in the corporate markets as well. The clients that you talk to, for example, in the US, Dubai, right? We talked a little bit about the increased volume of queries, for example, that come in from clients as the volatility is looking at their tolerance limits, and they're coming into that. Tell us a little bit. I know you guys have like a very robust way for people to come in, query the pricing, be able to challenge the price and receive some additional insight and input from the experts on our valuations team. Talk to us a little bit about that, what you're seeing there, how we're servicing that, because that, I think, is a hugely important kind of level of comfort and trust that our clients can derive from working with our experienced valuations teams.
Yeah, I think we get a tremendous amount of challenges, especially in like the distress type space, where markets are a little bit more, some of them could be a little dislocated at times when you have markets that are kind of trending downward, and and there's a lot of problems with the credit of the company or the country or whatever it might be. But we certainly have, and we have a lot of clients in that space, but they definitely have opinions on where they think the levels are. They may share contacts that they have that we might be able to reach out to, and then we can kind of compare it to the market information that we receive. So it's a good give and take. A price challenge doesn't necessarily mean, you guys are terrible, but it kind of means like gives you an opportunity to investigate. Like sometimes these markets are not perfect,
Sure.
very subjective at times, and
Sure.
it's a good interaction.
Well, sometimes a price challenge simply means that the model of volatility hasn't recalibrated to the current market move, right? So
Right.
I think opportunity to learn on both sides for sure. So, I mean, we talked about the volatility, we talked about the model calibration, we talked about the spread adjustments. We're sitting at a market that, you can now get 4 or 5% in developed market rate markets. It's quite an interesting kind of position. I think, from what we are seeing through the indexing lens, people are thinking through allocations, global allocations, asset type allocations, right? So, the rate and investment grade markets look quite different than they did a couple of years ago. What are you guys anticipating going into year end, and positioning both from our side to make sure valuations? December 31st is probably one of the most important pricing dates throughout the year, and for our clients as well. What are you hearing there? Maybe we'll go round robin. Start with Steve.
Okay. Yeah, I think market experience would suggest that as we head into the rest of the year, I think the markets become less liquid. I think we'll have fewer actors investing as they wrap up their balance sheets and their goes for year end. What central banks do? Well, that's just an open question. Just means we'll have probably slightly higher price volatility. That's fine. We've had it all year. I don't anticipate anything too material from here, but I could be wrong. In terms of how we approach year end, we will approach it the same manner we approach every year end and every day. High degree of diligence, a high focus on accuracy and timeliness to make sure that the numbers go out correctly. We have an established process for year end to make sure everything goes out right, because obviously people are very, very sensitive about marking their balance sheets appropriately and accurately, and we will be business as usual.
That's what we like to hear. That's what we like to hear.
Yeah, I mean, I think we're definitely going to see the volatility is going to still be hanging around for a little while. Maybe we'll see a little bit of upside movement at some point. I mean, you see it in equities just the other day, just kind of you get a little rally there, and then you get the treasury markets just rallied, on Thursday dramatically. So, and then we also saw that in the emerging market USD type stuff. So, yeah, I mean, it's still going to be volatile, but we'll see what happens with the Fed and what they do. So.
Well, I think it's going to be a little bit interesting, actually. Usually for this market, things should start to slow down as we're fairly seasonal. However, because of the rally you saw last week, you did see a significant movement in rates, specifically mortgage rates. So we tightened quite a bit. Basis tightened 30 bips. You saw current coupons come down 30 bips in the 5.4 range. So, which is pretty significant considering we were well over 6 about 2 weeks ago. So what that means generically is that you're starting to see a pop in pricing. And the question is, will this continue? The expectation that maybe Fed rates will not in the January meeting may not be as high as before, will now make bonds price, at least at the TBA level, start to price slightly higher. You start to see them less discounts, so you're starting to see your 5.5s at par. So as those discounts start to move up, refi incentive starts to improve, especially in that coupon area. So what you'll see is call protection start to pick up a little bit. So we think it's going to be interesting going into the end of the year. I mean, as far as what we're going to do differently, I think our process is fairly established, such that we'll be able to capture price movement. But the volatility hasn't ended here. The party's still going
on. Definitely a party, but I think clients are in good hands. With all of the work that your respective teams and the broader reps teams are doing. So, with that, I just wanted to thank you so much, gentlemen, for taking the time to share your thoughts and your insights with us today. We, I think, have tackled most of the questions that I know certainly I wanted to ask, and I know that are top of mind for our clients. So I think we'll continue to watch, we'll continue to price, and I think that brings us to the end of our live stream. So I just wanted to thank very much our audience for joining us today. We hope you found this session very, very helpful, as I know I have. And if you'd like more information or support, then please do get in touch with us. And on that note, if you've enjoyed today's episode and you want to find more, please search Refinitiv Fixed Income Data Services or below on the caption. Thank you so much for joining.